Boom. All right. Good afternoon, everyone. My name is Scott Christensen. I'd like to extend a warm welcome to all of you who joined us today for Navigating Taxes for Startup, a webinar with extended Q&A. This workshop is part of our ongoing Startup Fundamentals series. This series is offered by UM Ventures with collaboration from Maryland Technology Enterprise Institute and the Dingman Center for Entrepreneurship at the University of Maryland. I believe it's now the Dingman Lamone Center. Um, Side note. To everyone attending the live session, please feel free to submit questions using the Q&A function. You can submit your questions anonymously if you wish. You can also feel free, Samuel and I were talking about it, you can just pop in with your question, just in the middle of the session if you have it. You can also wait to the end. This session will also be recorded. Obviously, you saw the recording note went on, and this will then be posted on the Startup UMD YouTube channel. So without further ado, today we're joined by Samuel Handwerger, who is a CPA, who is a full-time lecturer in the accounting department at the Smith School of Business. He holds a Master's of Science in Taxation degree from the University of Baltimore and has a wealth of experience in industry, which I'm sure you maybe elaborate a little bit on. And so with that, I'm going to pass it to Sam. And anything else?
That's,
I think that's it. Yeah, take
that's
it away.
good. That's about as much of an introduction as I deserve and want. So
Yeah.
we're good to go. Thank you very much. Welcome, everyone. We're going to go to my screen. We're going to start right in. The purpose of today is to talk about if you are in the thinking process of starting a business and you would want to know what are the tax implications and things you need to be thinking about, or even if you've been in business for maybe a year or two, perhaps even 3 or 4 things that maybe if you haven't been concentrating on from the tax perspective, you might want to think about. So what we'll do is we'll give an overview and then I'll take questions and answers. However, if you don't understand something while I'm speaking about it, please put it in the Q&A or interrupt me because it's a small enough group. We can get real friendly here with going back and forth and answering questions and zeroing in. So we don't even have to wait to the Q&A if you want to dialogue a little bit further on any particular area. And on that note, let me just say that it's no embarrassment to ask any questions because no other than the infamous Albert Einstein has been quoted by more than one person at the same time, hearing him say, so it's pretty well documented, that the most difficult thing in the world is the income tax. And so if he said that, then then you're going to have questions. All right, here we go. We're going to go to the screen of the day, and that'll get us started. So that's our topic, startup tax strategies. As I said, it's not just nearly the first year, it could be a couple of years into the business as well. All right, so the main issue is to understand that you do want to plan for taxes because the typical scenario that I've had in my experience, particularly even with clients, is that they call me up and say, okay, I made this deal, I made this contract, I did this transaction. Now what happens? And I say, well, can you change the terms of the transaction? Well, we already made the deal. We already signed. All right, so here's your tax result. And it's not good. But if you had done something else, it would be better. And therefore, tax planning ahead can definitely save tax money. And it's not cheating. It's not tax evasion or fraud. It's just what the law allows you to do is to plan your transactions in a way that might result in less taxes. As long as it's still within the tax code, it's legal to do so. All right, the first thing we'll talk about is what kind of business entity you should be from the standpoint of tax, because there are a variety of different types of entities that you can have, and we're going to talk about the implications of each one. So let's go through what some of these are. The first thing is many people start off as what we call a sole proprietor. That's simply you have an idea about what you could do to make some money or help the world, and you decide to begin doing it. But you don't do anything special, you just start doing it as an individual. That's what's known as the sole proprietorship or sole prop. This is the easiest to understand from a tax standpoint in the sense that all the income tax implications are on you. Very simple. The bad part about this is not necessarily tax, although it could be. The bad part about it is that all the legal liability issues, and we'll put this in red, all the legal issues will be on you. So if you do something wrong and you're subject to a civil suit, then it would be your assets, your income, your future assets that might have to be used in order to satisfy if you were on the losing end of that legal issue. So the result of this is that while it's not necessarily a horrible thing from a tax perspective, it's not a good idea to be doing business as yourself, particularly if it's going to be taking off, if it looks like it might take off. Create something that will give you what we call legal liability protection. Protect this. So let's see how we do that and then talk about the tax implications of that. So you may have heard of a limited liability company, or LLC, and that solves the issue because with the legal liability, there's no legal issue on you. The legal issue will be simply on the LLC. Only the assets inside the LLC have the problem. All right, so that's good. Now you get the picture, by the way, that CPAs don't only address tax issues, they also address the legal liability issues and other structural issues that might exist with insurance products and employees and plans, even raising capital. We do take into account in our discussion of business entities with our clients, which one will make the most sense for them based on their business model and forecast. All right, so an LLC has the legal liability protection. Only what you put in there can be lost, and that's really good. Now, if you're an LLC and you're the only owner, you own it 100%. These are easy to set up, by the way, in any state, costs virtually nothing, easy to maintain from a legal perspective. You almost don't need an attorney. It's hard for me to do anything in a public nature where I say don't consult a lawyer, but you almost don't need one. Hint, hint, hint. All right, you're the 100% owner, and that means you are now, we can talk tax, you're going to get some real good acronyms here today. LLC is one, then you're going to be a single member LLC. That's what we call it, SM LLC, if you own an LLC 100%. And what makes this interesting is, what does it mean from a tax perspective? This idea of a single member LLC, perfectly legal, by the way, to do this, owned 100% of the LLC. From a tax perspective, the tax code has decided that a 100% owned LLC is nothing different than a sole proprietorship from a tax standpoint. Do you have the legal liability protection? Yes, you do. Do you have an entity that is taxed? No, you don't. Do you have an entity that's going to be taxed to you as we discussed here? Yes, you do. That's exactly right. So the LLC as a single member is ignored for tax purposes. That's the result. So we still don't have a tax-paying entity, but we have an entity that protects you from the public, from the legal issues. And that's why the most prudent way to start off any business is not as a sole proprietorship, but as an LLC. Single member means that you would now be just taxed as a sole proprietorship. However, you now have a choice. And one choice would be to say, okay, I would like to be taxed in a different manner. And you have what we're going to call check the box regulations at your option. This is an election you get to make. You don't have to do it, but if you elect to take the check the box regulations into account, you can become taxed as a S corporation or a C corporation. And those are the check the box choices that you have. And if you take on a partner, so you're no longer an SM LLC. Isn't that cool to say that way? You're no longer a single member. You have a partner, you have another owner, even a 0.1% owner. His partnership can be filed as a partnership tax return, which is not much different from a tax perspective. It's like two sole proprietorships together. So it doesn't really change a whole lot from a tax perspective. However, you got these things here, and now we got to learn what these entities are. In doing so, it would be helpful to understand what the taxation of a sole proprietorship really ends up to be. As I said, it is taxed on you. You report the income. You also report the losses. on your own return. You report profit or losses. If it's profit, you'll pay tax on your individual return. And if they're losses, that presents an interesting concept. If the losses show up on your return and you have income from other sources, let's say you're the typical sole proprietor, you're the typical entrepreneur. You're working to support yourself because you need to eat and live. And then you start a business, but you start it on the weekends, you start it in the evenings, and you start to have sales and service charges and so forth, and you're beginning to make money. If in this beginning phase you have a net loss after deducting your expenses, we'll get into what all those expenses are later, but if you have a net loss, that loss offsets your other income. And in the beginning, that saves you taxes because on your other income, you're paying tax, but the loss will offset that, so you'll have less income. The theory of taxation is, as you may have an idea, is it's how much income do you have in total from all sources minus any deductions that are allowed by law, by tax law. And then you get to what we call the net taxable income. We'll just abbreviate net taxable income. That's what the tax rate is applied to, and that'll be your tax. So if you have income from, let's say, a wage earning job, a full-time job, and you have W-2 income, and then you start your business and you have net losses, that will come under the category of reducing that income, so your net taxable income will be lower. All this basically means is we're not advising you to have losses. Heaven forbid, you really should try to make as much profit as possible. But what it's letting you know is that in the early phases of your growth as an entrepreneur, the losses can help reduce taxes from other income that you might be earning or making. And that has a nice effect because then you pay less tax. Now, in the event that you don't have other income, the losses could carry forward depending on how much it is. There is a concept of a net operating loss. There's another acronym for you. And that means that the losses that you don't use against other income in the year that they happen could carry forward to future years. So far, so good. You might be saying, hey, it's nice to have those losses on my return. If I have to have them in the beginning, that's nice. And I wouldn't say no to that. I would say that that is a plus because you're saving taxes against that other income or future income. Now, the other problem with
Sam,
yes.
I've got two quick questions. Well, one's not
Sure.
actually quick, but
Okay, good.
do you want me to bring them in now?
Yes, please.
The first one is we had a person ask about they would love to hear the pros and cons of member managed LLC versus manager managed LLCs. So maybe I don't know if that gets worked in.
Okay, member managed means that the people who are labeled as members manage the LLC. What was the other title?
Member managed LLC versus manager managed LLC.
Yeah, so in my book, I would always choose the manager managed LLC management managing it, because if you're the main cook and bottle washer, as they might say, then you want to be able to control. If you have a member managed LLC, then you got to be careful who's labeled as members. The management concept means that you might have board of directors, you might have other members of the LLC, but they're not going to be in charge. You would be the one named as in charge. You would name yourself. Of course, your bylaws would state how that vote of who that manager is, but I would probably vote for that more than having members be involved in that decision-making process. The bylaws are going to be the key to dictating how that all will work in either case. And is there any follow-up question to that so far? Because that's a little bit of a different issue other than tax, but because it doesn't affect taxation.
Um, I don't know. Let me see if I can make it so that Sam chose the one who asked the question. Sam,
Okay.
I've, I've just allowed you to talk. If you want to, you can pop in and if you have any further questions.
Yeah, do you hear me?
Yes, we can hear you.
Oh, perfect, perfect. Okay. No, I was just wondering because normally in the context of startups, you end up partnering with other folks as founders. So one of the issues, well, it's not an issue, but what we ran into was I guess my brother and his founders they founded their entity as a member managed LLC. But like you said, Sam, it is preferable to be a manager managed in the sense that for operating purposes, it just eases the process. So I guess my follow-up would be like, how would a transition? I mean, this is not directly related to the taxes, but like, is the transition to a manager managed something that can be seamless? Just any advice on that would be helpful.
Well, what'll happen is if you're going to have more than one owner, you're going to have a partner or a member in your LLC who's like a partner with you. You're going to have bylaws, and those bylaws will be drawn up. That's where I would probably recommend, you can get them done yourself online, but I would probably recommend having an attorney at least get involved a little bit with those bylaws. And what's going to happen is your members who are coming on with you are going to be looking at those bylaws before they really agree to be a member. If they're the money people, then you're going to wind up having more input from them on what those bylaws say. If they're working with you, they should still have input on what the bylaws say, but it's the old golden rule. He who has the gold rules. And so if they are the investors or the people who are supporting the startup from the money aspect, they're certainly going to have something to say about that. And it may be very difficult to dictate one way or the other. And if you choose one way and you want to go the other way, generally speaking, the bylaws are going to say for a decision like that, it may need to be unanimous or a 2/3 vote. And that's what you want to try to do in the beginning, is to make sure that those types of decisions, when they come up, you have the ability to say, okay, well, me and my friend, or I'm going to have 67%, so I'll be able to vote this one way or the other if it comes to that kind of hit. Does that help?
Yeah, absolutely. Thank you.
Okay, no problem. That's a good question, and that's, again, you can see that CPAs are not immune to answering those questions because they are part of the concept of what's going to make good sense from the business standpoint, even though it's not tax related. Outside the scope, now that you're on it, Sam, thanks for the question. Outside the scope of this is that when you have other members of your LLC, and that's what they're called when you have a shared ownership of an LLC, they're called members. And they don't have to be managing, because you could have, like you said, a manager member. Could have a managed LLC, management member LLC, or you could have member LLCs all being involved in it. But these members share in the profits or losses. Again, a little bit beyond the scope, but these profits and losses are going to be passed through to your other members. Let's talk about this pass-through idea for 1 minute, because it will become important when we get to some of the other entities. The pass-through concept means that just like the sole proprietorship, all the profits and losses fall on you, recall that. A pass-through entity means that all the percentage shares of profits and losses pass through to the individual owners or members. We'll call them owners now. So they pass through to the owners. So we could have owners 1, 2, 3. And if owner 1 gets 50%, then 50% of the profit or loss goes there. And if that's 25%, you get the picture. And this pass-through means that each one of these owners or other members will have either profits to report if the profit determined here is a profit. If it's a loss, that'll be their percentage of the loss will pass through to their individual return, and they'll get to use that loss against their other income, like we described with the sole proprietorship. So the pass-through just means that it's not a taxed entity. That's the main concept. A pass-through entity, we call it PTE, that's what we call it in our trade. Pass-through entity is not taxed. The tax is on the individual owners, and likewise, the loss passes through to them. That's an important concept to get in your mind in terms of what business entity you're going to be. Oftentimes, your investors, not just you, but your investors would be interested in sharing of losses, if there are losses in the beginning, because it offsets their other income. Potentially, there's a couple textbooks on that. But in a general sense, we could say that that's what would happen. Those losses would pass through and could potentially offset other income of your other members. So that's an interesting concept of the idea of having a pass-through entity. So I'll just circle that and say PTE, pass-through entity. Okay, back to the choices of check the box. That's how we got started on this. Because one thing you could do, if you have members, if you have owners, let's say you have a LLC and you've got a bunch of members, you could just leave it like that, be taxed as a partnership. So you have a PTE, which means it's a pass-through entity, and the entity itself is not taxed. What we're saying here is there's only one level of tax on the individuals. I'm going to complicate this up a little bit because I think it's important for all starting entrepreneurs to understand this next concept. And it may have implications even if you've been in business for a little bit. There are two types of, I like complicating it because I think it's really important. All right. So there's two types of taxes that can happen in a business setting. One is an income tax. The entity itself could be taxed on its income. So there could be a tax on an entity. And let's just mention it now. The C corporation is the only business choice model that you have out there that is a tax-paying entity. It pays taxes on its income. So that's one type of tax out there. The next type of tax is, and this has been in the news a lot lately, and will probably be in the news a lot more as we go in the next few months, Social Security. Social Security is a tax on earnings, and we're talking about earning money in an entrepreneurship. Income is a tax on earnings and passive income, dividends, interest, capital gains. So income tax is a broad-based tax. Social Security is a tax on earnings. And when you're in business, you're going to earn money. That's the idea. So that creates two levels of tax. This one is basically a 15.3% tax, and it's a flat tax. There's a little bit more to it, but we'll leave it at that for simplicity today. Point. When you're a sole proprietorship and you're earning money, so you're a sole prop, you're earning income, and here what I said, you're earning income. So income, there's an income tax, and it's earned. So now it's subject to the Social Security tax. We'll just abbreviate it that way. That means your tax as an entrepreneur is taxed in two different ways. Here, the rates are from 10% all the way up to 37%, depending on what tax bracket you're in. And this is that 15.3 flat tax. Yuck. If all your earnings, if you're looking at good earnings, significant earnings, you're looking at what could be a potentially high amount of tax when you add in the 15.3% flat Social Security. Now, at some point, this levels off to just being 2 times 6.2 or 12.1. Because the Medicare portion of the Social Security tax that I'm referring to drops off after a certain income level. It's about $160,000, $170,000. So you're getting a flat tax at 15% approximately for quite a while. There's a slight tax deduction allowed for the Social Security tax, so it comes out to be a little bit less. We don't need to go there. We just need to keep the concept in mind of when you have earned income and you're either a sole proprietorship or you're a member of an LLC, being taxed as a partnership, you're a member of the LLC, even if you're the majority member or the founding member, you're getting that pass-through entity, and that pass-through entity oftentimes will not only be just income, it'll be income that was earned by the LLC. So in the event that it's not just like interest earnings or capital gains inside the LLC, but it's what the LLC's really been formed to do, and that is make money by doing something, make money by selling something, then income will be also considered earned, and it'll be subject to the two levels of tax, the income tax and the Social Security tax. Okay, so let's go back to check the box regulations where this is how this all started, and look at some of the other choices that you have in mind, keeping the Social Security tax as part of the discussion here. We already know that a C corporation is a taxed entity. We just learned that. To get money out of what the C corporation earns, if it earns profits, to get that out of there. So let's go to C corporation now. So you got a C corporation. Let's say it earns income. And inside the C corporation, it's earning income, but not Social Security taxable. It's not, even though it's earned by the C corporation is not an individual that goes to retire someday. So the C corporation doesn't have a Social Security tax. However, you as the owner, you want to be paid for your services, and you should be paid. When that gets paid to you, it get paid as a salary. That'll be earned. That'll be income to you, and it'll be subject to the Social Security tax. If it's paid to you as a salary, then it reduces the corporate income tax in a C corporation. Wow, this is going to get fun. I didn't plan to go this far into it, but I think it's not a bad idea. And I'll try to be brief and move on to the other topics, and we'll maybe take a break in a second just to see if there's questions. But with the C corporation, it pays tax. It's the only tax paying entity choice out there. So it pays tax on its income. However, if it has, as an example, $100,000 of income, and it pays out salary to you, the owner, or the owners, $100K, that $100K reduces the 100 here, because this is a deduction, and the net result is zero, and there'll be zero tax at the C corporation level. Now, if you go to pay this salary of $100,000, and that's reasonable, the tax code and the IRS will say no problem. However, let's just see what happens in a different scenario. $10 million profit at the C corporation level, and you decide, gee, I don't want to pay tax at the C corporation level, and we'll talk about why. I don't want to pay tax there on $10 million. I want to take a $10 million salary and reduce the tax at the C corporation to zero. That is a great idea from a tax perspective, but the IRS will say, and the tax code says, it's not reasonable for what you did, and they'll say that doesn't work. If they say that doesn't work, what happens? We'll do this, and then I'll take a break and see if there's questions, because this is crucial to the rest of the business entity discussion. If we wind up taking in a not reasonable salary, the IRS will come along and say, okay, some of that salary is reasonable. It was 10 million. We'll say 1 million was reasonable for what you did. How they base that on, they base it on what you did, what did other people doing that make. That leaves 9 million that gets taxed at the C corporation level. So it gets taxed. And that tax is a flat 21%. Which doesn't look too bad compared to the Social Security tax and income tax rates when we looked at the individual. Recall the individual goes 10 to 37%, plus 15% for the earned income portion, which is all that money, all that net income. And so 21% looks like, hey, well, let's be a C corporation. The problem is that you got $9 million profit here. And generally, most people who are in business want to buy a boat someday. Someday they want to use it. And in order to get it now out of the C corporation, because you can't get it out as a salary, it's not a reasonable salary to get out 9 million more. You'll have to pay a dividend. You've heard of those things that corporations pay. And that dividend is not deductible. So it doesn't reduce the 9 million. You still pay tax 21% on the 9 million. Plus the dividend to you is taxable as a dividend. Now it's taxed at the rate of up to 20%. So you go from 21% to another 20%, and you're looking at a potential 41% rate on all the income from a C corporation. In other words, it's taxed twice. It's taxed twice. Let's do that. Take a quick break, because we're now going to transition to the S corporation to see a methodology of solving that kind of issue. That's the issue of you got a lot of income, which would be nice. Any questions so far? Let me see where you're holding.
Yes. So we had a question in the chat. I can just read it to you if that's okay.
Yep.
For a two-member LLC where both members had separate W-2 jobs during the year, but only one member actively worked on the LLC, in parentheses, investing significant time and effort, how should we report income and expenses on our taxes? Does the active member's involvement affect how profits or losses are allocated, even if ownership is 50-50?
Yes, the beauty of the pass-through entity known as a LLC, which gets taxed as a partnership, the beauty of that is you have the discretion, you leave it in the bylaws, but you have the discretion to pass the income to the various members based on criteria that is agreed to by the members. And that criteria could simply be that, hey, I earned it this year, and here's the formula of why I'm the one who earned it, because I worked a certain number of hours. That's one way. It was my client. That's another way. There's many ways you can craft the calculation, but the person who earned the money inside the partnership, the LLC, could be allocated all of the profit, if that makes sense, or a higher percentage of the profit than their membership ownership. So you don't have to have the profit passed to the members in the same category of their ownership. In fact, this is fun. In a partnership LLC taxation vein, in that entity, you have actually three ways to or three ownership levels, let's call it that. You have a equity ownership, which is generally your 50-50. I'm a 50% member, I'm a 50% owner. And that would be upon liquidation, you get 50%. That's what's known as the equity ownership. You also have a profit ownership, which is a profit percentage, how much profit will go to you. And that doesn't have to agree with your 50-50. In fact, you can change it year by year. You'd have to draw up some internal paperwork, like a little memo, everybody signs it, and you can change that every year. You also have a loss allocation ownership. So you could split the losses differently every year if you wish to. And again, same idea with the profit. So there's three levels of how you can handle the pass-throughs of those pass-through entities. One, or at least the partnership anyway, the LLC. There's three ways you can do it. Equity, which is liquidation. What do you get when you get out? Profit percentage, loss percentage.
Awesome. Well, a wealth of information here. So I think we're gonna check that one off. We got another question. Clarification question. Is Social Security tax applied to gross income or taxable income?
It's applied to the net earnings, So you have to look at what your income was. I think we are all familiar with the basic concept of it's income minus allowed deductions, expenses, and that bottom line is what the Social Security would be taxed at.
Awesome. So that's the last question Q&A we have in the
Okay.
chat at least. If anyone has anything, feel free to pop it in now. If there's a way to raise your hand, we can let you speak if needed. So maybe we'll just give another 15 seconds if anyone has any questions. And we'll get back to it.
All right.
Okay.
We're going to just complicate things just a little bit for a good reason. We're now going to take a look at, we were talking about this, check the box. We've now covered partnership, which is a pass-through entity. It's not taxed. We covered the various ownerships. You can have equity, loss, or profits. You know, you can divide things up differently. And we spoke about the C corporation and its drawbacks, because the C corporation is basically put you in a scenario where it may be taxed twice, taxed at the C corporation and then taxed when it's paying dividends. So that gives you a concept of what the C corporation. Now we're going to talk about the S corporation, which there's arguments for or against in my world of tax lawyers and tax CPAs, tax accountants, but there is a general consensus of what is the advantage of being a C corporation. So let's talk about that. I mean, an S corporation. An S corp is not taxed. It's not, even though it's a corporation, it's not taxed. And your LLC could elect to be a S corporation through that check the box. It could say, I want to be taxed this way, but it doesn't make it a corporation under state law. An LLC would be under state law, a corporation would be under state law, and S corporations are not part of state laws. They may have it for tax purposes, but it's not for the legal liability protection. Main thing to get out of this is an S corporation is basically a tax concept. It's a tax concept. And in the idea of the S corporation, you could think of the word S as being small business corporation. Make it easier for the small businesses to operate, because it's nice to be a corporation, maybe from an entity standpoint, maybe to raise capital. But if you're a corporation and you have to pay taxes as a corporation, you got to follow all kinds of rules. So it was a impediment to small business. So they created what's known as an S corporation or small business corporation. Some people use the S to refer to that. It's not tax, it's a pass-through entity, just like a partnership, but not exactly like a partnership. So it is a pass-through entity. It doesn't pay tax. It passes its profits and losses to the owners, number 1, 2, and 3, whatever those owners are. And the profits, and here, unlike the LLC that we just had that great question about on dividing it up in different ways, where equity ownership, profit ownership, and loss percentage ownership, the S corporation doesn't have that. So that's one drawback to the S corporation. And that means that whatever your ownership percentage is, that's what your profit and loss allocation needs to be. So just say that whatever your ownership percentage is, and whatever your owner percentages is, that's also your equity. So any payments out, any cash out has to be distributed according to ownership. So you're a little bit constrained compared to the LLC partnership concept. Everything's got to come out according to percentage of ownership. However, watch this. Let me pull a rabbit out of my hat. We talked about the C corporation, and in order to get it to be, let's say, a zero tax, we talked about paying a reasonable compensation, and there is an issue on what's reasonable. So if you make enough money, that could be a problem. Even if you can get out all the profits and not have tax at the C corporation, you're going to do so by paying a compensation, and that's taxed both at an income tax level and Social Security. So you're going to have both because it's going to be paid out as a salary. Now, the S corporation comes along, and the S corporation idea is you're going to have income, you're going to have expenses, including salaries to owners, because they don't work for nothing. And then you'll have a net. The net will pass through entity, don't forget, pass through to the owners. And that pass through, the net, the bottom line is not Social Security. It's not earned income. It's considered income from your investment. Income from the investment. It's not even a taxable dividend because all of the profits and losses are passed through to the owners and they pay the tax. So it's not even a dividend. You're going to pay the tax on the net income anyway. So what it means is that if you take a low salary, take a really low salary, that's the only amount of the income. That's the only amount of the income up here that'll be taxed for Social Security. That's the only amount. This would not be subject to Social Security. So to give you an example, I think that will make it easy. I'm going to borrow this example. I am not politically inclined one way or the other. I don't really give a damn. I don't give a damn about governments. No government is any good in the world anyway. Let's leave it at that. I'm just kidding about that statement, but I'm not even politically inclined. But I'm going to use, at the risk of getting yelled at by the Dr. Pines of the school, I'm going to use President Biden as an example because his tax return was released a couple of years back. And we noted that he had an S corporation. And it was for his writings and his speeches. And it was after he had been vice president. And he had a really good year, one really good year. He had $10 million of net income from the S corporation. So if he paid that all out as salary, there would be tax at income and Social Security tax, which would have been not necessarily the best tax result, because here's what he was able to do legally under tax law. This is all public record. What he did in these S corporation is he declared a salary of, let's say, about $150K. So that got taxed as income tax, of course, and Social Security, because it was a salary. It was considered earned income. Then what is his, we'll say his accountants did the rest. What his accountants did is they took 850, 9.85 of the $10 million. So it's 9.85 million. And they said that that was not a salary, but that passes through. That's a pass through. Again, it's pass through entity. So this amount of income passed through, and President Biden paid the income tax on that. at whatever rate he was at, but there was no Social Security tax on it. And that is the game of the S corporation. That's the game of it, is you go for as low a salary as you can for what you did. And we're not making any judgments on whether the salary was reasonable here, but it has to be reasonable. But you go for as low a salary as you can to justify, to have that amount subject to Social Security tax, as opposed to the whole thing, which if it had been a partnership, it would have all been taxed at Social Security level. So the net result of where we're holding right now is when you get together with your CPA and you're planning your tax entity choice, you can see some of the issues that are going to be involved, that are going to be talked about. And that is, and we'll just do a stop again just for purposes of re-energizing our brains as we go to the next topic in a minute. The issues are going to be how's the entity taxed? Is it a tax-paying entity? What happens with Social Security taxes? Is that an issue? How are you going to pass the profits to the various owners if there are more than one owner, that becomes part of the equation of which entity you're going to choose. And if I'm making an argument, and I wasn't planning on doing this, but if I'm making an argument for why you want to get together with the CPA early in your planning, this is the reason for doing it, is in order to come up with what's going to make the most sense. And lastly, I'll say, and then we'll just see if there's any questions before moving on, is that the check the box regulations are great because you can control your fate from a tax perspective, regardless of whether you're an LLC under state law or a corporation under state law. You get a lot of ability to make the tax choice different. That's great. However, once you check the box, that box remains checked basically for 5 years before you can check a different box. If you want to uncheck and check a different one, you can do it, but you got to wait 5 years. All right, that concludes about two credit course. Any questions? And then we'll move on to things that are of a little bit easier, also as important.
We did get a question, a follow-up to the LLC question, the 2-member LLC question we had before. Can one member of a 2-member LLC opt out of reporting the LLC on their personal tax return if they were not actively involved, even though the LLC is pre-revenue and only incurred operating losses?
Yeah, look, if the LLC agreement allows a member or all members to vote on their percentage allocation of profits and losses, if they agree to that right from the get-go, or at any particular point, they agree to be flexible in how that's going to be worked, and they just vote on it year by year, then yeah, you could have in the beginning in the bylaws, understanding that you're not going to get passed through losses or profits or both, or reduce the percentage of your ownership. So yeah, you have that flexibility with a LLC taxed as the partnership.
Okay, sounds good. So we're good with that question. So no more questions at the moment.
Okay, good. All right, now we're going to move on, which means your brains will be less fried than I got them to from where we just left off. But I think it's a good exercise. So early in the morning. All right, here we go. All right, so next on the issue, just to wrap up. So you can see tax implications of each entity there are tax implications, how they worked regarding tax reporting and liability, and whether you can change entity, when and how to do that. We talked about that. We talked about the pass-through, the PTE concept, and we talked about the C Corp here. All right, so we've done good. And we talked about what's called self-employment tax, which is basically Social Security. We call it for entrepreneurs, it's known as the self-employment tax, but it's the same thing. Okay, in the beginning, when God created the earth, the heaven and the earth. Oh, wrong class. Okay. Startup phase tax considerations. When you are beginning an entity or a business, you will have often prior to when you actually start business. So that's what this is all about. Prior to when you actually are in the business mode, you may have expenses. They get treated differently for tax purposes compared to when you are running the business, when the business is open. They are not allowed to be deducted. You can take a Section 195 election to deduct or amortize the startup expenses when you start, but you can't deduct those while you were not operating. They are considered like investment expenses. It's like investing in something, but you're going to have to see whether it's going to yield any dividends or gains from the investment. It's just buying the investment at the beginning before the business opens. So that gives us to this little doohickey right here, which is like the timing of entity formation for optimal tax treatment when you're beginning a business or in the stage of getting ready to start a business, is you want to be conscious of and speak to a CPA about when to actually form the entity from a tax standpoint and how to capitalize it, whether your money inside the entity is for an investment, meaning ownership, or whether it's for a loan. Those are all things that come up to play. All right. See where we are here. Okay. Oh, so one more thing about startup expenditures. Timing. The best thing you can do in order to avoid the issue with startup, which is prior to a business beginning, is just try to start as soon as possible. Try to start your business as soon as possible. Sometimes it's not easy to do. Again, you want to consult with a tax professional if it's becoming an issue because you're spending a lot of money to get to the phase of being able to operate. You want to speak to a tax professional about how you might be able to get the business considered to be a business. Because once it's considered to be a business, then all expenses are going to be able to be deducted against any income that you have. You won't get involved in having to determine how much of startup expenditures can't be deducted right away, and they have to be spread out over 15 years. That's basically the concept. Startup expenses that are before the business is in operation, generally you're looking at having to spread them out over 15 years if they're significant. If you get the, if you're having only if you only have like 5,000, you'll get to use those in the first year, but you have to make the Section 195 election. Sounds complicated, isn't it? Yeah, I'm not trying to get business here, by the way. So I'm all just trying to get you thinking as to the types of questions you're going to need to get answered. All right. Financial management for tax purposes. Let's talk about that. You want to set up proper books and records. You're going to need to choose whether you're going to be cash basis or accrual basis. Cash is as it sounds. It gives you a little bit of flexibility because you can determine whether you're going to have income or an expense, depending on which way you want to go, either profit or loss at the end of the day. You can, if you don't collect the income, it's not income, it's not taxable. So you can control, if you're a cash basis, you have a little bit of control on when you're going to have to pay the tax by maybe saying to your customer, it's December 15th. Hey, customer, why don't you just wait till January of next year and then pay me then? As long as you don't run the risk that they won't pay you, that means you can defer the tax from this year to next year, or vice versa. And the same thing with expenses. Let's say you're looking at the end of the year, you got $100,000 net, and you're looking at the tax on that, and you say, "Oh my goodness, that's not great." So you can pay out money before the end of the year, accelerate expenses by prepaying costs in the next year. You could prepay with cash, and therefore you could reduce your net income just by using cash to your advantage. So the cash basis accounting oftentimes has a lot of advantage over accrual. Accrual means looking at when did it legally happen? When it's legal. When did you earn the money legally? When were you entitled to the income legally? When were you entitled or required to pay the expense? That's accrual accounting. Accrual accounting will say, when was it earned? We don't care if you got paid. When did you incur the expense? We don't care if you paid it. You got to recognize it in the year when it's legal. All right. So you're going to need to have, either way, you need to have good bookkeeping system, a software. Generally, QuickBooks is the place of choice today. QuickBooks is probably the best. This is really important. So I'm going to stop here just for a second and just emphasize this, because we've been through some really deep tax complex issues with the S Corp, C Corp, pass-through entities. But one thing for sure about having a business entity and having that entity become the flow through for all income, all expenses, all activity of the business. And here's what I want to show you. This is the business. It's a box. It might be your LLC. It might be your C corporation. It might be your S corporation. But once you have that entity, the business is in a box. All of the activity of that business should go through that box. So if you're here, this is you, and you're putting money in, you put the money in order for the business to be able to pay expenses. If the business doesn't have income because it's not ready yet, or it hasn't earned anything yet, and you need money to pay expenses, you put it into the box, it pays the expense to whoever it pays. It collects the income from wherever it's coming from. And it puts this box into a neat package which records all business transactions. If you suddenly start paying expenses yourself, it's legal to do so. If you start collecting income yourself, well, that's legal to do so as well. But you got to keep extra books and records in order to make it straight, to be able to show somebody, particularly the IRS, exactly what the income and expenses were of the business. So the box really creates a way of looking at your business where it's not your personal account. You're going to do all the activity inside there. And if you need money for yourself, you'll take money out. You'll take the profits out to yourself by way of salary or distribution. So before you spend any personal expenditures, the best recommendation I have is don't do it from here. Take the money out, then pay your personal. Can you do it inside there? You can. In a pass-through entity, you can do it inside there. In a C corporation, you can do it too, but it gums up the works. I don't recommend it. Don't do it. Get all the personal, both money coming into the business and things that you need to pay for personal, get it out of the box. Let the box be simply all the business transactions itself. That's what we mean by separating. All right, and then we'll just cover this and okay. Record retention, basically 4 years for tax purposes, 4 years. I know the big companies, public companies have a 7-year requirement. You don't have that. This is your minimum. You can elect to do longer, but the minimum is you want to keep records for 4 years. All right, and make sure you keep all invoices of both billing clients, that's your income, keep that as part of the 4-year requirement, and expenditures. We're doing good on timing, by the way. We're further along than what it might seem like. Okay. Let's move on to the next topic, which is understanding business income and deductions. We've been talking about these terms, and we have a general idea, but let's talk a little bit more. What's taxable business income? It's when you have earned it. And that means you delivered the service, you delivered the goods. And it may be based on contract where you have multiple steps in delivering the goods or the services. You might be earning percentages as you go along, but when you have delivered what you're required to deliver, and there's a price that the clients are supposed to pay, that becomes income. Cash basis is it won't be recorded as income until you receive it, but it would be income. How about business expenses? Here we go. Business deductions, let's talk about what that means. So we already talked about income. It's when you've earned it. And business deductions, if your cash basis is when you pay it. If it's accrual, it's when you've incurred it legally. And let's just talk in general about what a business deduction means. A business deduction is an expense that was incurred, and this is where I use this is where I get the undergraduates, you won't laugh, but I get the undergraduate students to laugh, is I say a business expense can be defined as the but for, and the extra T is, of course, where the laughs comes in, because it's really this. Means I spent money, I spent these dollars, but for the fact that I have a business where I'm trying to make money, I'm trying to get business. I wouldn't have spent this money but for I'm trying to earn income. That's basically what the tax law says is what a deductible expense is from your income earned in your own business. So for example, if you take somebody out for a dinner, and that dinner, why did you pay for dinner? Because here's why. It's a potential client or it is a client and you need to discuss business and you're trying to create goodwill. So you take them out for dinner. The tax law allows 50% of that dinner as a deduction. Most expenses is 100%, but dinners got abused, or lunches and dinners got abused, but at least you're only incurring it, but for the fact that you're in business and it's a client or potential client. Anything you spend, even if it's not successful in getting income or making a better profit, whatever you spend, but for the fact that you're doing it for the betterment of your business enterprise is deductible. Okay. Some common business deductions we're going to talk about. And the timing is based on a cash or accrual, which I think we've already incurred. The timing is based on cash or accrual accounting and also based on the fact that where are you? If you're in year 25 and you've already got a lot of earnings, maybe you want to defer net income to the 26 or vice versa. So timing is, and the reason for this is because our rates of income tax are progressive. They go from bottom up. They go from 10% all the way up to 37%. So if your net income for a particular year is going to put you up here, but if you were able to put some of the expenses into that year and reduce it to a lower percentage that year and spread it out. So instead of 37% in 1 year, you might spread it out where it's 25% over 2 years. You can see that you're going to pay less tax on that income. Because if you pay all the 37% for 100,000, that's $37,000. But if for 100,000, you're able to spread it out and pay 25,000, not 25,000. It'll be 25% of 50 and 25% of 50, and it'll be 25,000 of tax compared to if it all fell in 1 year. So the timing strategy, if you can play the game, it's a really important game. Let's tell you what, all right, let's talk about the common deductions and we'll take a break. Okay, and we're almost done. All right, so here's Schedule C, which is for a sole proprietorship, but it gives you a list. It's a great form to go to. You just look up Schedule C Form 1040 on the Google search, and you will be able to get this plus its instructions. And it really gives you a good list of all the types of expenditures the IRS expects a business to have: advertising, car, commissions, and you can just go through and get an idea. In case you're not sure what is an expense, this is a great way to get an idea. And there are many others, of course, but this is pretty good. And don't forget, you want these all to run through if you're a sole proprietor, and remember I said about running everything through the box. So just set up a separate account, set up a separate checking account under the name of the business and have all the activity go there so you can see and show somebody all the business's profits and losses, all the business income and expenses. All right, let's see where we're holding here. Hold on, let me get a second. All right, we are ready to talk about a interesting topic. We're very close to, we're on time, but we're just spreading out the Q&A a little bit. Any questions so far?
We just had another question. I'll go ahead and read it. If the C Corp option is chosen for the business, does it mean the business owner does not need to worry about anything on the business when filing a personal tax return?
Read that one more time.
If the C Corp option is chosen for the business, does it mean the business owner does not need to worry about anything on the business when filing their personal tax return?
Oh, correct. Right. The only thing they would worry about is whether the C corporation paid them a salary, which would be a W-2, That's simple enough. The C corporation would issue the W-2 like you're working for it, and you'd report that on your individual return. If they paid you a dividend, they would give you a 1099 DIV form to say they paid you this amount in dividends, and you report that, and you're done. There's nothing else. There's no pass through from the C corporation. You're just completely done. Yeah, so that's that. I think that's a correct statement.
Simple. Lickety split.
Yeah, yeah.
Alright.
It's a way of keeping the two really separated. It may not be the best for tax, but it's certainly less complicated on your individual return. And that brings up one point about all these pass-through entities. If you had thought of the question, well, how much am I supposed to pick up on my individual return from the pass-through entity? That was a good question to think of. And the answer to that, which many of you may already know, and that's what's known as the Schedule K1. Schedule K1. Schedule K1 is what the pass-through entity will give to the owners. This is your percentage income. This is your percentage loss. This is your percentage this, percentage that. It'll allocate all the numbers that came from the pass-through entity that you have to pick up on your individual return. And that's probably where that question derived from having experience of needing a K1 from the pass-through entity in order to recognize it on the individual return. Very good. All right. Issues with compensation and personnel. This is not the salaries to you. This is to other people. And we're going to talk a little bit about employee versus independent contractor classification. An employee receives from your business a W-2. An independent contractor receives a Form 1099. The Form W-2 tells the employee how much they made and how much taxes were withheld. That's what the WH means. So you as an employer, if you're paying an employee, you must withhold income tax. You must withhold Social Security tax, the employee half of Social Security tax, and you must withhold state income tax, which we won't do differently. We'll just leave it at withholding income tax and withhold and pay, and you also have to pay the payroll tax as an employer. So you have to, these are the withholdings. You take it out of the salary of the employee. It doesn't cost you any money, but you have to pay it to the government. So while it's not your money, you're taking it from the individual, the employee. Okay, so that's fine. And this is 1/2 of the Social Security. Remember that 15%? This is 1/2 or 7.65%. You pay payroll tax, the other half of the Social Security tax, the employer pays that, 7.65%. You also pay workers' compensation to the state, and depends on the state rules and the state insurance rates. Let's say it's 1%. You also pay unemployment insurance to the state. It's required in most cases. Let's call that 2.3%. Then you might have some other. You might have to pay for health insurance. We'll skip the benefits that you might have to pay for employees, but let's just take a look at this. Look, this already adds up to greater than 10%. So as an employer, to pay an employee $1, it's going to cost the employer 10, usually with benefits, it's at least 15%. So if you're paying $1, the employer is going to wind up paying $1.15, 15 cents for benefits and payroll tax, etc. Now, all of a sudden, every $1 you pay an employee, it's not $1, it's $1 plus. And it's not just plus a little, it's a significant amount. You get the picture. That's not the case with a Form 1099. So I'm going to erase the board. Keep this in mind. All these payroll taxes for paying somebody as an employee. So we erase the board and we go back to the 1099 as an independent contractor, and there are no payroll taxes. Payroll taxes, what happens to them? None. The employee is going to be responsible. The independent contractor, I should say, is going to be responsible for all of it. What that makes for a slate where people say, if you're an employer, you're going to say, well, I'd rather not pay the payroll taxes. I'll call everybody an independent contractor. Well, that's nice, but you can't do that. The IRS basically says who's who depends on what they're doing. And it's really depends on what level of control do you have? Over the individual. If you tell them where to work, when to work, how often, how many hours to work, where to show up, how to do it, they give you supply, you give them supplies, you give them a computer. The more you have that level of control and take risk out of the employee's job function, maybe they can't lose money if they work, they get paid. If they lose their job, that's not losing money, it's just losing their job. If there's less risk on the employee from the standpoint of are they going to make any money or not, then that starts to get them into the category of being an employee. And it's based on facts and circumstances, which means it's often quite difficult to determine who is who and what is what. But if the more facts and circumstances point to an employee, then the IRS is going to want that person classified as an employee, which means you're going to incur all those payroll taxes. If you try to play the game of calling people independent contractors to not have to pay payroll taxes, that's where you'll probably get in trouble, because again, it's not based on what you call it. It's based on what is it. And let's get into one tax doctrine and then we'll move on. And it's called form versus substance. Most areas of tax law will say, we don't care what you call it, what is it? That's how we're going to tax it. So you might call somebody an independent contractor by having an agreement, a contract. That's nice, but that doesn't make them independent, even though you have the formality of it. If the reality, the facts and circumstances say they are an employee, that's the substance, then you have to treat them that way. And the contract means nothing. So what happens when you have an employee, you have payroll tax obligations and deadlines, and you're probably going to want to use a payroll service. That's something that I would recommend highly to outsource. They do a great job at very fractional costs. They know what they're doing. W-4 is what you would give an employee. They give it back to you. It's not filed. This is not a filed form. You would give an employee a W-4 and say, here, fill this out, give it back to me. Then you would give it to your payroll department, your payroll company. They'll know what to do with it. If it's truly an independent contractor, you need to give them a W-9. They give it back to you. They sign it. And that gets you your federal ID number when you go for the person. It gets you the federal ID number for the person. So when you file the 1099, you know their name, the address, and the number. Those are the requirements. If for any reason you're paying a non-resident alien, you will not have a W-2. There's no W-2. But you may have, and there is no 1099 because they're outside the country. But you may have an obligation to fill out a form 1042S, which requires withholding tax to the non-resident alien. So since it's a complicated area, I'll leave it at, if you have a non-resident alien that you're paying, they're overseas, seek tax counsel on how you pay that and what you have to do when you pay it. It's all going to be based on tax treaties and what they're doing for you and so forth. So this is just a word of caution. Okay, owner compensation strategies. We actually spoke about that when it comes to the S corporation and avoiding the self-employment tax, which we'll now call self-employment tax. Same thing as the Social Security. We already spoke about that. We spoke about the idea of trying to pay out more salary from a C corporation to reduce its taxable income if you have that. So that's part of that issue there. Okay, business asset strategies rather. Let's see what we're talking about here. Okay. So when you're buying assets of the business, these are no longer expenses, they're expenditures. Expense is you pay it, you get something and it gets used up right away. An expenditure is when you're buying something that has a life to it. The life it's a trash can, it has a life to it, but we don't worry about that because it's usually a very small dollar amount. We're talking about large dollar amount assets that you might buy, equipment, computers, trucks, cars. things of that nature that you're buying, but for the business need. And so those are not expenses, but they're expenditures. At least the good news about it is they are subject to what we call depreciation. Depreciation means that you get to deduct the cost of it over its useful life. That's the general concept of depreciation. So you depreciate it over its useful life. Let's write that out better. The useful life will be dictated by tax code, and it's fairly generous. It's fairly generous. So you might buy a computer, that'll get the cost of that'll get written off over 3 years. You might buy a desk, that'll be over 3 years, and it might last you 20 years. You get that. You might buy just a general equipment, that's 3 years or 5 years rather. So the concept of depreciation is what happens if you buy something that has more than just a short-term life to it. It allows you for vehicle expense deductions, and that would include depreciation as well as your expenses for keeping the car up or the truck up, which is gasoline and repairs and maintenance and tires and things like that. All right. Before we leave this concept of the useful life depreciation, I want to just mention one more thing, and that is when you're in the startup phase, spreading the cost of that over its useful life might be very helpful because you don't have a whole lot of income. So when you spread it out, it might make that those expenditures, that depreciation gets used when you have income. On the other hand, let's say you're in business already and you're having a good year, I hope, that would be nice. You can buy new assets that year and up to a fairly generous amount, like in the millions. Section 179 comes along and says you can deduct 100% of it in that year, in 1 year, the year of purchase. There's also bonus depreciation. So what this means is in many cases, you want to check with a tax accountant as to some generous concepts of what might help you take a purchase and expenditure of a more than 1 year useful life asset and get the deduction all up front, all of it against income of a good year. And one just quick example, which I think will help illustrate, and I'm going to take a little break again because we got time, and I'm really down to the last couple slides. A couple of years ago, I had a client who had a $25 million net income year. It was during COVID. And he did it legally. It was all, his business basically moved online and he had no idea he could sell so much online. And so he had a big year, $25 million net income. And we'll just say, wow. And of course, he comes to what happens in my field, in my profession, is he comes to me towards the end of the year and says, I made a lot of money. Yay. Then he says, but I don't want to pay taxes. Everybody says that to me. I don't want to pay taxes. Okay. Go to another country, go to jail. Your choice. So I off the cuff, I just jokingly said, well, the tax law in that year and still allows for a complete 100% depreciation of a private airplane. It's a way of tax law encouraging people to buy airplanes. It helps the economy. So 100% depreciation in the year you buy it. So I jokingly said, so you could go out and buy a private jet for $25 million and you'll have no tax to pay on your $25 million net income year. So I hung up. A week later, he says, I bought the plane. He does. He sends me the invoice. $25 million private jet. His net income becomes zero. He had no tax to pay. Okay. Maybe it's not so simple, but that's what he did. All right, let's take that little needed break and see any questions you have so far. Anything come up, or are we doing good?
Nothing yet, but I mean, do you see any, I have a question.
Yeah, sure.
Just with the federal, the stuff happening at the federal level, like, do you foresee any major changes to, I just don't keep up with IRS tax law. It's not my domain. Do you see any major shifts happening in reality?
I see the
Broad
following.
question, but
So let me get out my crystal ball. And what I think is going to be that we're going to see is we're going to see a major tax bill proposed by the GOP. And a big part of that will be to extend the tax law changes they made in 2017, which sunset at the end of this year. They made a whole bunch of changes to tax law in 2017. They sunset at the end of 25 this year. The reason why they did that is it's often hard to get the entire Congress to agree to major tax law changes because you got to balance the budget, and some of the changes affect positively or negatively certain elements of our economy. So oftentimes they've been, the last 30 years, they've been making tax changes based on, well, this will expire and we'll go back and relook at it in 5, 10, 15 years. And that's what they did in 17. They had a tax law change that expires, it sunsets at the end of this year. So the first order of business is that the GOP, which was the element, the Congress that passed that 2017 tax law, they're going to probably try to get all of those tax changes extended either for another 5 years or 10 years or make them permanent. They're going to try that. And there is some word on the street that the tax rates in certain categories of our economy and individuals and businesses will change. I heard from President Trump, at least I thought I heard from him, that he's looking to have anybody at $150,000 or less for income to not even have to pay a tax. Or I don't know how possible that is, because again, they got to balance the budget and they still got Social Security. But we are going to see a fairly major tax bill this year, whether it'll be an overhaul of the system such that we might even call it an overhaul. I wouldn't put it past the GOP to put something together that huge, but I don't think I don't think that will be what passed. But we will see a lot of tax changes this year. So it's a good year to stay tuned and see how it's going to affect 26. It won't affect this year. They'll be affecting 26. Now, they could go back and retroactively change a few things in 25 or 24, but there's a few things they're thinking about, but it's not likely that'd be a major part of it.
Okay.
Okay.
Interesting. We just got a question about getting your email to contact you, and
Oh,
I just
sure.
your public facing faculty page,
Yeah.
which has your email on it.
I'm going to give that at the end, and I'm going to do a little commercial for that. So stay tuned. We got another 10 minutes and then we'll be wrapped up.
Okay.
And I'll do that commercial. You'll see it is a commercial. Okay, here we go. So we are now at, we were talking about vehicle expense deductions and record keeping. Let me just mention one thing about using your auto for business. If you use your auto for business, yeah, there's a deduction there to reduce your net income. There are two ways to do it. One would be the actual, and another would be to take the mileage, because the Internal Revenue Code has a mileage rate. So if you drive, and I think the mileage rate was like, I don't know, like 65 cents, something like that in 24. And it goes up or down depending on the cost of operating a car, which basically means it'll go up or down based on the cost of gasoline. So if it's like 65 cents per mile and you drive 1,000 miles, so you get a $65 deduction, which is, you can reduce your net income that way. No, that's not right. 65 cents. It's not a $65 deduction. I'm cutting you short. Let's get it right. Get the math right. A $650 deduction. 65 cents per mile. $650 deduction. That's meaningful. So the mileage rate can work pretty good. The actual, you can probably come up with a higher deduction if you use more than the mileage rate. You can probably come up with that. But the record keeping is god awful. The IRS has a whole bunch of regulations and requirements on showing actual expense. You got to keep all the records really good. I don't recommend it because it just invites an audit, and it invites the auditor to get more detailed in the audit itself, because they're going to have to look at all these records. I prefer the mileage rate and just make life easy. Mike, you've made it easy for yourself. You've made it easy for the auditor, and you get, it's not, all right, it won't be dollar for dollar what the actual costs are, but it'll come out okay. I also have, which I can send to you later, maybe I don't know if I can do it today when the chat box, but I have a blur. I wrote a memo just the other day on the differences between the mileage and the actual expenses of a car, so you can see that. Another thing that comes up quite often is the home office deduction. There is a home office deduction allowed. It's going to depend on the type of business entity that you have on how you're going to handle that. But if you are using your home for your business, don't forget to talk to your tax advisor about how to get that deduction on your return. There are easy ways to do it, and what you're going to wind up getting out of it, it's not I don't call it a home run. I call it like a base hit in baseball, to use that metaphor. It's going to help, but it's not going to reduce all your taxes like that jet airplane, but it'll help. And basically what it does is it takes certain expenditures like supplies of the house, or the utility costs of the house, or the real estate tax of the cost of the house, or even if it's a rental property, the rent. These are all usually personal expenditures that people have, and they're not deductible. If you work as a W-2, none of this gets deducted. There is no home office for a W-2 person anymore. It might come back, but right now it's out the door. It doesn't exist. It's one of those sunset provisions at the end of this year. So you can't, it used to be you could take home office costs if you were an employee, but you can't do that now. And so the result is, what if you're an employee and you're your own boss? How do you take a home office? There are ways to do that, easy ways to do it. And the advantage of it is you can see these are all personal. And now part of them reducing your taxable income, which other people who don't have their own business, they can't get to that. That's the advantage. All right, tax advantage business expenses, education. You don't have to, if you're training yourself to make yourself better in your own, again, your own business, this is all for your own business. You can reduce your taxable income by seminars that you go to, courses that you take, business travel, and meals and entertainment can reduce your net income. Your health insurance for yourself helps reduce your net income. Retirement planning, I can't de-emphasize this. This is not just IRAs, this is qualified retirement plans, which you put money into, part of your earnings, part of your net income, you put it in there, it reduces your tax. It's tax deferred until you retire, and you can do it for employees, and it's all great stuff to help reduce taxes. There are lots of non-taxable fringe benefits out there that you can pay employees, including yourself, and any business insurance you have. Those are, again, an idea of what you can deduct to reduce your taxable income if you're in your own business. How to pay yourself. We've talked about salary is taxable. Distributions, we didn't go into this, but S corporations, we sort of talked about that it's taxable, but it's not taxable for that Social Security. So that's really what that was about. And we did that. Tax differences we did. Reasonable comp, we talked about self-employment. We don't need to talk about this because it's really just it's for a tax professional. All right. Yes, and so if you have a C corporation, that's where this would come in. How to get money out of your C corporation so it's not subject to the double tax. It would be paying yourself rent for a home office. That's one way. Paying yourself for other types of benefits that employees can have. All right, we are almost done. Tax compliance and planning. This is the last slide coming up, which is there's tax filing deadlines that are different for the different entities. If you are a business entity, particularly if you're a pass-through, you may have the requirement to pay estimated taxes. If you're a C corporation, C corporations have to pay estimated taxes as well. So we'll say C corps. Don't forget state and local obligations, which could be that you may need to file in different states if you're doing business in other states, either online. And this is going to be said for both. I'm going to mention this. I'm going to mention it offline. I'm going to look at you and speak about this because this is the last point. This is the last slide. And then we can still take some Q&A. Don't forget about the fact that you may be doing business in other states, even if you don't have an office or an employee or a warehouse or any physical presence under today's new regime of state taxation, both for collecting sales tax, if you're selling something subject to sales tax, or income tax in other states. It could be just based on how much business you're doing there online. You never step foot in Pennsylvania, but you're doing business online there. You're collecting the fees online, you're collecting the services online. Many states now have what we call economic nexus. Economic nexus means you have a presence there based on the amount of business you're doing there, and you may have an income tax obligation. And if they have a sales tax obligation on what you're selling, even if you're selling services, some states now have sales tax on services. Then you may have an obligation to collect sales tax in that state for the services that are being paid from that state, from the people who are in that state paying you. You may have an obligation to charge them sales tax, on that service that you're rendering. It's a complicated world out there for small business owners. The best, I'm going to go back to the slide so I can do the commercial, but the best advice I can give you is that you need to be educated as an individual, like in seminars like this, on some of the concerns that you want to know about, so that when you go and talk to a CPA, you have at least some idea what they're talking about, and some idea of some of the questions to ask based on what we've learned today. Now, the commercial works like this. For your individual tax returns of you or your family members, TurboTax UMD, which is, and this is free, and it's part of the Smith School, giving students real life experience preparing tax returns. TurboTaxUMD.org, that's our website, and you can go and make an appointment. We got plenty of spaces for appointments between now and April 15th. We give the students great experience, and you also can get to me, yours truly, through that. And you can ask me questions about taxation, tax planning, and I'll be glad to answer them. I am a practicing CPA, but this is not an excuse to give a commercial for that. And I'm not going to do it, because that's not why I'm here. I'm here out of the goodness of trying to help our students and our alumni in their entrepreneurial ventures. But you can get to me that way through TurboTax. So take advantage of it like that. Just email the general email address. You'll find it. You'll find me anyway if you know how to work the UMD system, and you can certainly email me individually through my UMD email address. I'll be glad to let you know. And what I've done in the past is oftentimes I guide some people to an unaffiliated, non-related CPA, or I'll tell them what to ask, and I'll tell them the concerns they should be involved with. Sometimes I actually answer real questions, and so that could happen too. It depends if I know the answer.
Awesome. You're saying TurboTax? I'm looking at if you just look up TurboTax UMD.
Yeah, if you look it up, you'll probably find us on a Google search. It's TurboTax, all lowercase, UMD.org, all one word. And we do tax returns for free. Like I said, we don't do business entity returns for free. Maybe someday, but we do the individual returns. And as I said, what it does is it gives you like a ticket to speak to me directly if you wish.
Very cool.
And I encourage that.
Awesome. Well, we've got 2 minutes left. Anything else you want to mention? And then I don't see any last minute Q&A. I'll highlight a couple other events that are happening, but then do you have any other thoughts?
If there's no questions, I'm good to go. I hope this was informative. We covered the business entities a little bit more detail than I actually had planned, but I think that was a good thing, because for startups, if this is supposed to be a startup issue, then that's certainly the biggest concern, is how to get that. Okay.
Awesome. I'm just dropping the links for the rest of the startup. I mean, people, if they found this webinar, they know where to go, but I'm just dropping the link again. And then next week on Wednesday, we're also doing an in-person seminar on HR, in the Rabin building on the engineering side of campus. So I think that's it. Thank you guys for joining. Nothing else to add, Sam?
I'm good. I wish
Okay.
you all luck. And if you have any specific questions, just do the roundabout, get me through TurboTax. I'll be glad to meet with you individually, one-on-one.
Awesome. This is, I learned a lot myself. That was very helpful. So thanks so much for doing this. This call will be recorded and put on YouTube. So with that, I think we can probably end it. Thank you, Samuel.
All right. All the best, Scott. You take care of yourself. Nice to have you.
Have a good one.
You too. Bye-bye.
Bye.